Uh, whoa, whoa, whoa. What is going on, guys? We are looking at data that I have personally never seen. Not only 26% short on our GameStop stock, but also 166% cost to borrow average. That is insanity. Why is it costing the hedge funds so much to hold down the fort? And why exactly are these stocks about to go parabolic? We have seen resistances at the $30 mark for AMC in the near past and for $200 at GME, which means that these stocks are likely going double in the next few weeks. I want you guys to make sure that you already understand when the mother of all short squeezes is happening, why it would happen now, and why the like button must be demolished before the video continues. Because if you watch until the end, I am not only going to show you more video perhaps of that mayo person, because mayonnaise is Kenny G's favorite thing to eat, but also a little 10-second clip from this whistleblower that's talking directly to Congress.
In 2008, two of the investment banks that I'd once worked for went bankrupt and saw their risky bets and bad practices nearly tank the global economy. Those banks no longer exist, however, the economy remains on edge.
That is true. That is why we are going to talk not only about the buy signals that you guys need to know, but also about what you guys should find out by Tuesday. The trading week is just starting, and I want you guys to be able to take it from a data scientist point of view. Thank you guys so much for sticking until the end of the video and commenting out which like you guys are all the way up to 1200. First things first, this is the graph that you guys should be paying attention to. A double bottom clear as day on AMC and GME. Both of these are looking at a common level of support. Now, if you guys have been trading with us, technically trading with us, you guys know even from the get-go that this is a human psychology question. Can we get enough people, bears and bulls, to agree? Because at the top of this sell signal, we saw that this was where most of the bears had a majority control, and they said, I want to sell at this point. Well, very similarly, bulls have been able to take that buy signal right here at the $8 mark and again close to that $9 mark. So that means that we are now facing a clear level of common support, and with that technical pattern across the 2-week trading window, that means that we are now having a very strong double bottom. And where will that double bottom bring us? George W. We are going to take a quick look at the last relative resistance, which was all the way at $30, around $29 and change, which is exactly why this buy signal here from Lux Algorithm is a beautiful green shining beacon. So if you guys don't have the Lux Algorithm yet, it's 20% off in the description down below. But I want you guys to take a look at Ortex. Guys, GameStop has a minus 2.4% short interest change, and yet its short interest is already near 30%. This has not happened since the January and the May gamma squeezes. That is when those stock prices skyrocketed. And you guys probably know that we are making gorillionaires as we speak, like this man right here. One of the things that you guys are probably paying attention to is the gamma, how much of the options chain is flowing into our stocks freely. You know, this is something that we want to be able to pay attention to, how many calls versus puts there are at all times. In terms of calls, we want to see that there are, in terms of AMC, 70,000 in the money calls, right? These aren't shares, these are calls. So we're looking at 70,000 in the money with a potential 100,000 more out of the money with a potential double bottom. This is that gamma squeeze that brings the price skyrocketing, because this is an unstoppable force. Something else to pay attention to is that we have 200,000 weeks coming up in June 17th, which is a fantastic 3-week gap between now and then, giving us a plenty of time to carry out that double bottom. And then in 3 weeks after that, almost 300,000 calls out of the money. So that is something that we want to be able to have an ongoing narrative, because as of right now, we are pulling a ripcord and knowing that there is going to be a lot of turbulence on the way back. Kind of like our favorite Mav, our favorite naval aerialist, Mr. Maverick Top Gun, bringing in a ton of revenues for AMC and GME. I'm going to come to AMC in just a second, but take a look at this. 5,000 out in the money puts and 70,000 out of the money. That ratio is ridiculous. And that's one of the major things about the Gamma chain right now, is that we are paying attention to a lot of bullish behavior, bullish options players. In AMC here, we are looking at 24,000 in the money. We are looking at 58,000 out of the money, and very similar ratio for puts. Basically the exact opposite. 3,000 in the money puts, and out of the money nearly 20x that, about 46,000, 15x that. So make sure that you guys have already paid attention to all of these figures for Tuesday. If you guys want me to be able to put out a Monday video, because I'm still doing another, I did 48 hours of research here, I'm going to do another 24 for you guys. If you guys appreciate that, make sure that you have already slammed that subscribe button, because that's the best way to join the Moon Platoon, right? Join the Andrew Mo Money gang by following us on Twitter and Instagram. It's always Andrew Mo Money. But if you guys want to be part of the Moon Platoon, easiest way is to hit that join button next to the subscribe button. But let's take a listen to what exactly is happening with Bernie Sanders here in Congress, listening to this this whistleblower from Wall Street tell it like it is. If you guys watch until the end, I will be showing you a little bit more of the mayonnaise scene.
Virtually, Nomi Prince.
Thank you, Chairman Sanders and Senator Brown, for the privilege and opportunity to speak before you today. I am a former managing director of Goldman Sachs. Before that, I ran the International Analytics Group as a senior managing director at Bear Stearns in London. I've held positions at Lehman Brothers and the Chase Manhattan Bank. After years on Wall Street, the levels of greed, unparalleled influence, and unethical practices in the industry caused me to step away. Since then, I've worked to uncover the manner in which the global economy and our financial system has become so unequal, unjust, and fractured. In 2008, two of the investment banks that I'd once worked for went bankrupt and saw their risky bets and bad practices nearly tank the global economy. Those banks no longer exist, however, the economy remains on edge. Today, nearly a decade and a half later, we sit at another precipice of grave risk. Asset management, behemoths, and private equity institutions have amplified the distortion in financial markets. The magnitude of their influence over securities and companies has no historical comparison. Their unfettered access to policymakers and major institutions spans the world. These new financial giants are leaving smaller market participants from all parts of the economic spectrum exposed to concentrated systemic risk and diminished representation. Yes, it's true that Wall Street banks remain as powerful and influential as ever, but now asset management firms with trillions of dollars at their disposal have become more influential in governments and the regulatory entities responsible for keeping them in check. It's important to understand that at the top of this financial hierarchy stands BlackRock. The financial Goliath manages $10 trillion in assets. That's more money than the size of any other country's GDP besides China or the United States. BlackRock's meteoric rise has seen its assets triple since 2012 and nearly double from 5 years ago. The world's largest asset manager acts as a money manager, private equity fund, institutional investor, trading software platform, and government partner. What's truly made it untouchable is its ability to produce and attract capital to exchange-traded funds or ETFs. ETFs are attractive because they offer intraday liquidity for both buyers and sellers in the financial markets. But what the shock of the early days of the pandemic in 2020 showed us was that frenetic ETF activity can intensify panic in the markets.
We talked about
Quick outflows executed in bulk can exacerbate a falling market, which can hurt those that can afford it least the most. Ultimately, leveraging its government connections, BlackRock was awarded a no-bid contract to manage the Federal Reserve's corporate bond buying program. The contract allowed BlackRock the opportunity to essentially support its own investment-grade bond ETFs in the midst of a pressurized environment. BlackRock and its execs had access to confidential information and the ability to formulate business decisions for themselves and their larger clients. No other institution in the world has or had such access during or since that crisis. Currently, BlackRock, Vanguard, and State Street manage more than $22 trillion in global assets. For comparison, U.S. GDP stands just shy of $24 trillion. The asset management industry has only grown more concentrated at the top over the past decade. These big three dominate the market. Their growing stranglehold on U.S. equity participation provides them greater chances to hold veto power or directly influence business strategies for nearly all major corporate decisions. As these institutions expand further into the world of private equity, their ability to dictate corporate control and outright ownership in every sector of the economy will have a greater human cost. Private equity business practices are largely designed to extract capital, not build it. As a result, small businesses and communities caught in the private equity crossfire will come under greater control of big finance that puts cost and job cutting ahead of worker stability. Today, BlackRock and these other institutions have expanded to such a magnitude that they effectively are the market. This represents a monopoly sort of influence over competition, assets, and transactions. It elevates the systemic risk that the global financial system faces. This renders everyday people, retail investors, workers, and anyone with a 401k retirement plan exposed to the risk that these massive trillion-dollar institutions pose. These individual shareholders of ETFs or other funds seeking to invest their hard-earned money in the markets and build for retirement have had their ability to obtain a seat at the table reduced. By creating a shareholder pass-through structure similar to the kind that Wall Street has used for decades, we can strive to even the playing field and reduce the immense power of mega money managers. This would enable participants invested in ETFs or other funds to hold shareholder rights with respect to the corporations in which these vehicles are invested. Currently, these rights are retained by the asset management companies themselves. We should enact policies focused on reducing the sheer size and concentration of asset management institutions and private equity firms to establish a more efficient, transparent, and equitable marketplace. The risk of corporate wrongdoing, fiscal mishaps, unfair tax advantages, and conflicts of interest is too great to ignore. So is the possibility of extreme price movements due to the leverage and trading patterns of these mammoth asset management institutions. Our financial stability and security depends on addressing this. Thank you.
Thank you. Thank you, Ms. Whistleblower. We have a very clear understanding of exactly how the very rich, just like she said, get more. The fewer get more every single chance they get, and this is just human nature, honestly, and you blame them right now. If you guys want to continue that blame train, I did promise you a little bit of the mayo guy. I'll just show you him eating a little bit of mayo. This is 32 ounces of mayo because, you know, Ken Griffin, he is the Citadel man. He is the mayonnaise man. He is not this man, but this man has it out for Kenny G's favorite snack. I think in the middle you see his cat. I think that's the important content we should see. There we go.
My mayo.
That's his mayo. Well, guys, I hope you guys enjoyed this video. Thank you so much for those of you who have watched my honest take on the AMC and GME squeeze. That was the last video. Make sure you guys have watched that. And if you guys want to make sure you don't miss out in the future, that subscribe button and that bell button is exactly what it's for, to make sure that Professor Meatball knows that you guys are still watching, and the join button and the Patreon button is how you guys get on the end list and get your access to the six-figure portfolio that I give each of my Patreons. Make sure that you guys understand that this is an ongoing journey, so make sure to subscribe and hit that follow for Instagram and Twitter. And I told you guys in the last video that I am creating a production. I am creating something that I'm hoping that I will be able to bring to Broadway. So if you guys want to hear some of that music in the future, comment down below, because that proves that you've been to this part of the video, the end. I said you should be, and I want you guys to tell me why you think it's important for minority voices, people who are retail investors who are in the space trying to tell their own stories right now, because this is a very important time to be alive. And I thank you guys for being part of this video. Thank you. We'll see you guys in the money. Peace.